There's no doubt that there's a fair bit of pressure for many households, and particularly those households that have mortgages or are paying higher rents. And obviously, the inflationary pressure is creating enormous pressure on budgets, and that is why we are so focused on keeping our prices low. And fortunately, across Bunnings, Kmart, and Officeworks, all those brands are renowned for their low price positioning. We are hopeful that we'll see some benefit for households through the Stage 3 tax cuts that may provide a bit of relief, but there's no doubt that things are tough and value really matters.
Bunnings is among some of the big box retailers that are set to be hauled before parliamentary inquiries to answer questions about profits following in the footsteps of the supermarkets. Were you expecting that?
Look, I was a bit surprised to hear Bunnings named as one of the companies that would need to present to that inquiry, mainly because Bunnings for many decades has been renowned for its lowest price positioning. But look, it is understandable at a time of cost of living pressures when many households are doing it tough that these types of inquiries occur. But from our point of view, Bunnings would obviously cooperate with any inquiry. And it will be a great opportunity for us to showcase the incredible processes that they have in place to justify their lowest price positioning. And we have many proof points that when Bunnings goes into a new region or into a new category, it delivers amazing value for customers, to our team members that end up getting paid more, and also to the communities where Bunnings operates.
Well, the opposition leader, Peter Dutton, has said the difference in profit margins between the Wesfarmers owned Bunnings and its smaller rivals like Mitre 10 is astronomical, are they?
Well, Bunnings, we're actually quite proud and pleased that Bunnings is a very sustainable and profitable business, and that enables us to pay more in taxes, more in wages, and continue to invest in our businesses and the community. The margins at Bunnings compare quite similarly to many international leading companies, and we're actually proud to compare our ratios to leading international companies. Comparing our ratios to companies that may not have as strong a commitment to lowest prices or may not have as successful businesses isn't really something we'd want to compare against.
On the lithium business, it posted a $26 million loss. Plunging lithium prices obviously come into play there. What's the outlook for that business?
Well, we think there's a positive outlook for our lithium business, mainly because we're investing in the construction of a lithium hydroxide refinery, and we're about 80% through the construction there. And then when the construction of the refinery is complete at the end of this financial year, we're very confident that that project will deliver good returns. But as you say, the lithium prices are quite low at the moment. We are seeing a number of lithium producers start to cut back on production. It's very hard to predict what the future prices will be, but often in commodity cycles, what you see is when prices are low, there is a supply response, and that can often lead to an increase in pricing down the track. But our business should be profitable and sustainable even at the current low prices.
The online business Catch continues to post losses and has fallen substantially in terms of its valuation. Do you regret buying it?
No, look, we don't regret buying it. I think what's interesting to know is that over the last 5 years since we made the investment in Catch, there has been quite a profound change in retail competition, particularly e-commerce. We've learnt a lot from buying that business, and our retail businesses have improved materially. Interestingly, we are now, across the Wesfarmers Group, doing in excess of $3 billion in e-commerce sales, and we have learnt a lot through the Catch experience. We still have more work to do to improve the marketplace, and we're working hard at that and improving the performance of that business going forward.
And finally, Rob Scott, you said that 2024 was fairly challenging in the face of a cost of living crisis. Where do you think growth is going to come from in 2025?
Well, one of the benefits of having a diversified portfolio and investing for the long term is that we have a number of avenues for growth. We feel confident that if we can continue to deliver the lowest prices and the low prices that customers are seeking at the moment, we can still create a win-win scenario of delivering value to customers and delivering value to our shareholders. And then we have some exciting opportunities in our industrial businesses and our healthcare businesses where we have further potential for growth in the years ahead.
Rob Scott, thank you so much for your time.
Thank you very much.